The book, Buying and Selling a Business by Garrett Sutton, is a book from the Rich Dad Advisor series. The author is a corporate attorney and an asset protection expert with more than 30 years of experience. He has also written 4 more books as a Rich Dad Advisor. Written in a clear and easily understandable style, this book provides the necessary knowledge to avoid the pitfalls and overcome the obstacles in order to achieve a winning transaction. Please subscribe to our channel and like this video if you find it useful. Don't forget to turn on the notification bell in order to stay tuned. Buying and selling businesses is not for the average investor. In fact, if you don't know what you are doing, buying and selling businesses can be the riskiest of all 3 investment classes, the other 2 being paper assets and real estate. At the same time, buying and selling businesses can be by far the most profitable of them all, again, if you know what you're doing. Here is the great value of this book. It gives you a deeper look into the world of business and equips you with the necessary steps and strategies to successfully buy and sell a business. Why buy versus startup? There is much less financial risk involved with buying an existing business than starting one up. It is that initial period from startup to breaking even that is the most deadly for a business. An existing business must be doing something right to still be in existence. The rewards of ownership and independence are the same for a startup and an existing business, but an existing business has a past to help guide the future. Why sell versus hang on? The best time to sell is when the economy and the industry are in good shape. While sellers have little or no control over these factors, they can keep their companies in prime selling condition in order to take advantage of unforeseen opportunities. Sometimes other events pop up and motivate a sale. Change in competition, death of a partner, unexpected changes in finances, divorce, or medical emergencies. The buyer and seller speak different languages. Both the buyer and the seller want the company sold. Both want as painless a process as possible. Both want it over quickly. Neither wants the business to fail. With so much in common, how could anything go wrong? Each is viewing the whole process through a different set of lenses. The buyer is watching the road ahead. All discussions are filtered through a view of future goals. In contrast, the seller is watching the rearview mirror. All discussions are filtered through historical contexts. Both are auditioning, both are posturing. Knowing this and trying to see through the other's filter can make the whole process a little more clear. Due to the different objectives a seller and a buyer have, the author analyzes each step of the sale from each side's point of view. What questions they should ask, what they should be aware of, where mistakes can be made. The importance of confidentiality. A company sale affects more than just buyers and sellers. Customers, vendors, and employees can all find out about the possibility of a sale, and emotional reactions are inevitable. Fear of what is to come may have some already looking for new suppliers, customers, and jobs. The fallout can be far-reaching without the owner ever knowing about it. Therefore, sellers need to be proactive from the beginning, sign confidentiality agreements, and be ready with a plan how to alleviate fears once people do find out. As a seller, you need to be very careful about giving out information. You don't want a buyer just fishing for deals or worse, trolling for free information about your business. It is advisable to protect yourself in writing by creating a confidentiality agreement. Preparation. As a seller, you need to present your company as a viable purchase. All financials should be clear and current. All company policies and procedures should be formalized. The more you have in writing, the easier it will be to overcome objections of the buyer. You want age on the documents. The fact that they were prepared 1 month prior to negotiations for a sale may be used against you. Be forthcoming with all the facts as you know them. Sellers are never sued for telling too much, only for not telling enough. It's best to disclose everything. Buyers analyze sellers, industries, and the business up for sale. Buying a business takes preparation, knowledge, and a little bit of faith. If you are not an expert in the industry you're considering entering, become one. Take some classes. Read extensively. Take a temporary job in the field. Look for a mentor. Search your network of friends and family for someone who has found success in your field. Once you start evaluating companies, double-check all facts yourself. Never take the seller's word. Ask. Be blunt. Be nosy. Learn early on the reasons the seller wants out of the business. Remember, buying a company has more than just financial liability. Your reputation, your personal finances, your family's future, and your personnel are going to be connected to this new venture. Be sure you have a strategic plan in place before you even begin to look for a company. Assembling a team of advisors. A good attorney should be the first recruit for both a buyer's and seller's team. The attorney will be intimately involved with every step of the sale process. Bringing him early on the game can save you costly mistakes. Be sure your lawyer specializes in business sales and acquisitions and has an understanding of tax law. But remember, your attorney should not be making business decisions for you. The legal advice supplements and supports good business advice, and not vice versa. After all, lawyers are known as deal killers. Just as with an attorney, a good accountant is indispensable for both teams. He or she should have experience within your industry and be able to explain complex issues in simple terms to help you make informed decisions. An accountant can be very helpful for a buyer, not just with analyzing the company's finances, but also with money-raising efforts, personal contracts, and etc. Business brokers act in the same way that real estate brokers do. As intermediaries between buyers and sellers, they have listings from numerous sellers and can search out the right business for a buyer. For a seller, the primary benefit for using a broker is confidentiality. He can pre-screen potential buyers to be sure of their level of interest, as well as their ability to pay, thus saving you the hassle of dealing with looky-loos and possible competitors. Selling prospectus. A selling prospectus, at its simplest, is a company profile designed to market the business to prospective buyers. Its goal is to generate interest and justify the asking price. It should be a persuasive advertisement, but false claims and exaggerations are not appropriate and can get you in trouble. The selling prospectus can be more or less detailed, yet before you have a confidentiality and non-disclosure agreement signed, you should leave out the following information: specific location, company name or address, detailed listing of hard assets, financial statements. As a seller, you should draft the prospectus yourself. No one knows your business better than you. But do bring in experts for advice. An attorney will be especially helpful to present the information in the prospectus in the proper conditional no guarantee language, so you won't be sued if the business is not meeting the forecasts. Financials. The primary way a buyer judges a target business is by the numbers. Financial reports must be accurate, credible, and meet professional standards. As a buyer, you need to get a CPA on board. The financials might look good for an untrained eye, but you need to be sure. If a seller will not disclose financial information, or if his financial information consists of a shoebox full of receipts, move on. Even if all the data is in perfect order and is prepared by a recognized accounting firm, you still need to verify. Look out for artificial increases in sales by a seller granting easy credit to customers, some of whom would normally be turned down. Though these sales show under revenues, they may never bring in any cash. Buyers should also look out for peaks in professional service fees. A peak in accounting fees can be a sign of an IRS suit. A peak in legal fees could be a lawsuit was filed. When considering the purchase price of a business, buyers should be conservative and err on the low side of sales and the high side of expenses. Account for unexpected expenses and the cost of buying the business. Be sure you are getting sufficient value for your purchase price. Liabilities. The sale of a business can be structured as an asset purchase or as a stock transfer. It's important to understand the difference. Buyers usually prefer asset purchases where they acquire the business's assets, such as equipment, property, customer lists, intellectual property, contracts, and agreements. This way, the buyer assumes no liabilities of the previous entity except the ones he agrees to take on. The sellers, on the other side, usually prefer stock transfers because they would pay less taxes on the sale. They might even offer a sales price discount for accepting a stock sale. The key here is that the new owner takes on all assets and all liabilities, whether the buyer knows about them or not. It's important to recognize that in a stock purchase transaction, there are significant risks for the sellers too. The seller may be held to an incredibly high standard of candor and disclosure under securities laws. The field of securities law is extremely complex and subject to shifting definitions. An honest and well-intended seller can be wiped out by an anti-fraud suit. Valuation. A business has only 3 things to sell: assets, the potential of those assets to produce earnings and goodwill, the rather intangible value of being a business. There are numerous valuation methods for determining the value of a business. Knowing what they are will give you the upper hand in negotiations. The most widely used method is the earnings approach, which measures the worth of earnings. This approach then splits into 3 different methodologies. Capitalization of earnings. The earnings for the past 5 years are multiplied by a capitalization rate. Discounted cash flow. Projected future earnings for 3 to 10 years, discounted at a specific rate. Ratio multiplier. Every industry has a formula for multipliers that considers sales, not profits. This is a simplistic method that can be used for a first-glance valuation. Both buyers and sellers will need a professional accountant to help with valuation. They may even want to bring in a professional business appraiser, which takes a while and costs a bit, but provides more objectivity. As a seller, don't let emotion get the best of you. Your business is your baby, and you've put a lot of time and effort in it. But if you want to successfully sell it, be sure you are not rationalizing your price out of the market. As a buyer, you'll need to understand the operations of the target company. It's not enough that the price is right. In order for the deal to be a good one, you'll want to know all about risks, all about taxes, and all about the operations. Negotiations. The initial asking prices for a company are on the high side. The gap between initial price and selling price tends to be about 10% and 25%. It's during the negotiations when this is decided. You can let other people negotiate on your behalf, your lawyer or accountant, but be sure they have your interest at heart and there are no hidden agendas. Even if you decide to handle your own negotiations, you'll want your attorney involved. He will be useful in identifying potential personal liabilities and making sure the lease is transferable and the proper permits and licenses are in place. Negotiations generally involve 2 key components: price and terms of sale. terms are just as important as price. The creative use of terms can overcome any objection as to price. Financing. When buying a business, odds are the purchase deal involves getting a loan. It's easier to get a loan for an existing business than for a startup venture due to the business's track record and assets. Buyers should research banks and look for a bank that is friendly to their situation, familiar with their type of loan, and willing to continue a friendship with them after the close of the deal. After all, the business will need a working capital loan too. It's the lifeblood, and is equally important as the acquisition loan. As a seller, you will likely not get the entire purchase price in cash. Some sellers will accept promissory notes secured by assets in the business. Others may prefer contingency payments, where a payment is made when the business meets certain sales targets. A seller may opt to take stock in the buyer's company, or take convertible securities as part of the payment. And either way, how the business is run after the closing is still important to you. If the business doesn't do well, you may find yourself struck with a useless note or stock, or backrunning the company you want to be free from. Taxation. Selling smart doesn't mean just price. Understanding the taxation element in the sale of the business can mean selling for a lower price and taking home more money. Be sure to get your advisors on board early in the process so you can shape the transaction to your advantage. The closing. When the buyer goes to the closing of the deal, he should have a list of all items to be picked up at the time. After the closing, the seller may be unreachable in the South Pacific for a while. The list should include ownership papers for all assets purchased, lease agreements, customer lists, buying licenses, transferable insurance policies, keys to everything. As you have learned, there are a number of pitfalls and obstacles to know and avoid when buying and selling a business. With the right team of professional advisors in place, and the necessary precautions taken on your part, you will succeed and even turn these obstacles into advantage. If you enjoyed this video, you are sure to like our summary of Tax-Free Wealth, another essential book from the Rich Dad Advisor series. Thank you for watching. Please check our channel for more videos like this. Tell us in the comments, what is your favorite book? Can't get enough of reading? Find us on Facebook at facebook.com/readandgrow1, and also on Twitter at twitter.com/readandgrow1.